Welcome to Financial Insider Weekly. I am your host, Michael Gray, CPA. My guest today is Jim Brown. Jim is a partner and business valuation specialist with Parachute, Tombor, Ramirez, Filler, and Brown. He's been with the firm since May 1997, only yesterday. Previously, he was a regional vice president at Union Bank and Bank of the West. Jim holds an MBA from the University of California at Berkeley and a BA in Business Administration with an emphasis in finance from San Francisco State University. He's an accredited senior appraiser in business valuation awarded by the American Society of Appraisers, the initials for that is ASA, and is a certified financial planner, or CFP, and he performs valuation studies for a number of purposes that we'll discuss in our interview. He also provides management and financial consulting services. And today, Jim and I are going to be talking about the role of the business valuation specialist. So Jim, thanks for joining me today.
Thank you very much for inviting me.
So I think I'll just go ahead and get started with some questions here. Okay. So I'm a certified public accountant in tax practice. I've seen the business valuation area sort of blossom out. Okay, I started way back in 1974, and it seems like things really, I guess from the mid-90s, really have come into their own. The use of a qualified appraiser is required in the tax law by the courts and even for financial reporting. So what is a qualified appraiser? And maybe you can comment a little bit on these requirements of using an appraiser now.
Sure. Well, before telling you exactly the answer to that question, we should talk about appraisers of what type of property.
Okay, why don't you go ahead.
And the organization where I'm accredited is American Society of Appraisers. And the ASA, we call it, has specialists in essentially all types of property that exist in the world. And we categorize them into 5 areas. One is the one that's most commonly observed by most people, and that's real estate.
Okay.
Another one is personal property. So personal property includes tables and chairs and antiques and fine art and things like that. Another one is machinery and equipment. We call it machinery and technical specialties. Another one is gem and jewelry. We know what that is. And the last one is business valuation and intangible assets. And that's the one that you're asking about.
Right.
And a qualified appraiser is an appraiser that's first accredited by a nationally recognized accrediting organization. There are several of those. And what's most important is that those accrediting organizations require specific education about the type of property that they're appraising, that they have examinations that are demonstrating what they've learned about the property, an experience requirement. Mm-hmm. You wouldn't want a surgeon that's doing their first knee surgery on you. You'd want some experience beforehand. Mm-hmm. And adherence to standards. Standards that we adhere to is something called Uniform Standard of Professional Appraisal Practice. You want an ethical requirement and an exam in ethics, meaning that the appraiser is always required to be totally independent of the parties involved in the transaction. Mm-hmm. And then lastly, and probably one of the most important, is peer review.
Okay.
You want to make sure that the work that's done by the appraiser is read and approved by a board of examiners to demonstrate that they actually know how to apply the work. Mm-hmm. So that's, and in recent times, in 2006, the Congress passed the 2006 Pension Protection Act and actually codified into law the definition of a qualified appraiser that pretty much goes along with what I just described. Accredited, experience, ongoing requirement for continuing education. I left that one out. Mm-hmm. Independence and following standards and ethical requirements.
Mm-hmm. Mm-hmm. Okay. So what are some of the areas that valuation studies are used for?
Well, when we talk about the a business appraiser, The most common is valuing a business itself. Mm-hmm. And we're either appraising the value of the entire business or a percentage ownership interest in the business. It could be for a transaction among shareholders. It could be where two people or more own a business and they don't want to be partners anymore and they can't agree on a value of the shares in the company or a partnership ownership. Mm-hmm. It could be when somebody has died. Let's say they passed away and they own 30% of the San Jose brick factory as a hypothetical example. And the IRS is interested in knowing what that's worth. Mm-hmm. So you need an appraiser who's not only qualified but independent, so that essentially they will give the same answer to both the government and the taxpayer. Mm-hmm. Other reasons for appraisals would be the sale of the entire company. We also appraise other things that are not ownership in businesses. We appraise promissory notes, debt instruments for different reasons. We appraise stock options. Mm-hmm. We appraise the value of businesses that own real estate that are set up often for estate planning purposes, where, as an example, someone might own an apartment building, let's say a 25-unit apartment building, and they want to pass that on to the next generation. But instead of passing it on directly, they might want to divide that apartment either among three children, or they might want to put it inside a partnership so that the partnership owns the building and they give away ownership in the partnership. Mm-hmm. So each of those has unique financial characteristic that business appraisers get involved with.
Right. And I guess another one that's a big area, I think you told me you don't do that much work in this area, and you're probably glad that you don't, is divorces.
Yeah, well, and we do that work. There's some unique things about the courts in California that are looking for certain prescribed methodology that we don't necessarily adhere to. Mm-hmm. And we don't think are as good as other practices, so we tend to stay away from that. But yes, divorces is another one. There's a husband and wife, and there's a family business, and they need to divide up the business. What is that worth?
Or try to figure out how much property of this type do I need to give for the business that's going with the spouse that may be running the business, or something like that.
Well, it even gets more complex than that. There's an argument that let's say one person owns a business, and then they own a business for 10 years and they get married. Uh-huh. And then they're married for 10 years and they divorce.
So now what's community, what's separate?
Well, they get into debates about how much did the value of the business increase between the date of the marriage and the date of the divorce.
Right. How fun. What about financial reporting? There's some new requirements that are, maybe I should say recent requirements that are coming in related to valuation that needs to be done there too, right?
There are. The Financial Accounting Standards Board is the entity that sets the accounting rules and standards that all the accountants, you're one of them, that comply with those. And in recent years, there's been an interest in placing assets and liabilities and information on financial statements close to market value instead of at historical cost like they've done traditionally. Mm-hmm. So, and the accounting world calls that fair value instead of fair market value for some unique reasons, although the values are very similar. Mm-hmm. So when one company buys another company, for example, then they're required to value intangible assets and put them on their balance sheet. Things like the value of a customer base, patents, trademarks, trade names, recipes, all kinds of esoteric financial intangible assets need to be valued and go on the balance sheet. So we get involved in that. Also, when there's a sale of a company made, companies are often sold not 100% for cash. Sometimes they sell for cash or cash in a note, but often the price is flexible, meaning that the parties might agree to pay a certain amount in cash at the closing of the transaction, and they'll pay more if the seller's estimates of future earnings turn out to be true. Mm-hmm. So that becomes now, how much is that contingent consideration? It's based on the probability of all those things occurring. So appraisers need to get involved in that and study the case and the probability of those actually turning out that way and applying a value to it.
Well, it sounds like you've got a pretty good crystal ball. Mine's broken. Anyway, so, and also I guess on this fair value thing, I mean, like once you've got these assets, like you said, customer list, whatever, particularly trademarks, patents, trade secrets, those have to be valued like periodically, isn't that right? Like almost every year?
Yes, yes.
To see if it's gone down
or more often than that.
Yeah.
There's a procedure called impairment testing.
Yeah.
So before the accountant prepares the financial statement, they're required to go back and look at these intangible assets to see if they're still worth what they said they were when they put them on the balance sheet. And that's probably a good thing, because when I was in the banking business, we would see financial statements that say included a building. The company owned the building in which it operates, and it bought it in 1960. And now you're 30 years after that. You're in 1990. And it says the building was worth $600,000. That's what they paid for it. Well, or maybe it's even fully depreciated, and all you're showing is the land value, and it might be worth $7 or $8 million. Mm-hmm. So it's a better reflection of what's actually going on to do a good job of estimating assets and liabilities at fair value.
Yeah, but it's a big change for public accounting that's, again, been traditionally cost-based. But it is a movement that's happening, though, of trying to look at this fair value. And the problem, to some degree, is how reliable are these things? Are we sort of creating air here that, that doesn't really have much substance?
And that's the essence of the debate about that right now, because appraisers are estimating value absent a transaction. Mm-hmm. If the property was actually sold last week, I know what it's worth. Mm-hmm. I look at the invoice and see what it sold for. But they're asking us to value property absent a transaction, and that gets very difficult. And in accounting circles, they're trading what they consider relevance for accuracy. Mm-hmm. So the numbers, when they're based on cost, might be very accurate, but it might not be very relevant to today. Mm-hmm. Mm-hmm. So we'd like them to be more relevant, but now they're less accurate.
Right.
So it's a trade-off.
Okay. Well, why don't you tell us a little bit about what is the process for doing a business valuation study?
Well, the value of a business, if you think about the value of real estate as an example, and people talk about real estate being based on location, location, and location. And we also talk about real estate in terms of its physical characteristics. Take a single-family home as an example. A 3-bedroom, 2-bath house, what is that worth in San Jose? You might ask me, well, how many square feet is it and where's the neighborhood? Mm-hmm. But having known that, you're better able to find something that's actually reasonably comparable by looking at other transactions. Mm-hmm. In a business, you can't tell very much about it by its physical attributes. We need to get into its financial attributes. So what we do is we look at 3 different approaches to valuing a business. One is we can take the balance sheet of the company, where most of the assets and liabilities are on the balance sheet at their historical cost. And we can put a column next to that and estimate the value of each individual asset, cash, receivables, inventory, equipment, other intangibles, and put their value next to it and restate the balance sheet at its market value. Mm-hmm. That's one method. What that doesn't pick up is goodwill value. Goodwill value is based on earnings of the business. Sometimes we hear people ask about goodwill and they say, well, let's go back to the brick factory, where we started in the 1850s, and great-grandpa started the company, and he founded the Rotary Club, and we're on hospital boards, and everybody in the community knows us well. We make the best bricks in town. Well, that's social goodwill. Mm-hmm. Economic goodwill says that all of those things that I just described, and the honesty and integrity of the management and their ingenuity, their management skills, all that results in better earnings than someone else would earn. and that's what creates goodwill. So just marking the balance sheet up or down doesn't catch the goodwill. So we need to look at the earnings of the business. So we introduced something called a market approach as with the second one. Market approach, we would study a transaction database of companies that are similar, that have actually sold, and we can identify their price and something about their earnings, maybe their net after-tax earnings. And we can calculate a ratio of the price divided by the earnings of the company. That's the PE ratio, the price-earnings ratio that people hear about. Mm-hmm. We also take that price and divide it by different levels of earnings, pre-tax earnings, earnings before interest, and so on. And if these other companies sold for that relationship between the price and its earnings, maybe this company would sell at a similar price. Mm-hmm. So now I have a second value. We also consider publicly traded companies because the information about the price and the quality of the financial statements is very good. Mm-hmm. So we study publicly traded companies that are similar and calculate their pricing ratios, or multiples they're called. Mm-hmm. And we need to adjust those downward because public company multiples almost always sell, public companies almost sell at higher multiples than private companies. So we go through an analytical adjustment process, reduce their multiples to apply to a private company. Now I have a third indication of value. And then the last approach that we use is called an income approach. And we look at what the expected future earnings of that business might be. They can be very different than the historical. Maybe a growing company is about to grow slower. Yeah. Maybe a company is about to obtain new customers and contracts and it's about to grow faster. So we need to study that and interview the management and find out what we believe is really reasonably expected about the future earnings. And we can take all those future earnings, estimate them, and bring all those earnings back to what we call a present value. Mm-hmm. So those are actually 4 different methods, and then what we do at the end is we reconcile those based on the quantity and the quality of the information that we obtained. Mm-hmm. And at the end, it's an informed judgment decision by the appraiser based on their experience and the information they've been able to obtain to decide on a final conclusion of value.
Okay. Why would someone need a business valuation specialist and that person doesn't even really have a business?
Well, one would be the case where they're doing some estate planning and they say they have real estate and they want to transfer the apartment building that I mentioned. Mm-hmm. And it's common that, let's say we take a $1 million apartment building and put it inside a partnership. And then we're going to give away 10% of that to 3 children each. Mm-hmm. So what's the value of 10%? Well, the building's worth $1 million, maybe 10% is $100,000. Mm-hmm. Well, in reality, it's worth less than that. And the reason it's worth less than that is that 10% ownership interest doesn't own a high enough percentage to control what they do with the building, when it might be sold, whether or not to borrow money against it or to pay the loan down against it, other than just the regular monthly payments. And so when we value a business, there's methodologies that we apply, mainly based on rates of return that we've observed in the market for other partnerships that are similar. And we can see what they've earned. And we apply that analysis to this case, the family case, and we find out this 10% might not be worth $100,000, it might be worth only $70,000, 30% less than its proportionate share of the whole. So what people can actually do, they can transfer property to the next generation at a discounted value, and they can transfer more property before the estate and gift taxes begin to take part of that out of it.
Right. So what it means is that there's a benefit from making lifetime transfers of these minority interests.
Yes.
And but then again, the person who's receiving it has to recognize what this all has to do with is there's a rule of valuation that it could be agreed upon between a willing buyer and willing seller that both have all the facts and so forth. So anyway, a knowledgeable buyer would not pay 10% of the full value, like you said, $100,000 for a fractional interest in a building when they in fact don't control it, and then they have to deal with the other parties that are involved and so forth.
Yes.
Yeah. Okay.
Well, that's just one example.
Yeah,
Another
yeah.
example of where you'd have a valuation not owning a business would be instead of putting the property inside a partnership or another legal entity of some type, you just give away 10% of the building. And that's referred to as a common tenancy ownership interest. Similar analysis applies to that, but in common tenancy, majority doesn't rule. It requires 100% consensus. So if you own 99% of the apartment and I own 1%, and there's major decisions that you would like to make about it, like selling it, if I disagree, you can't sell it. So that's very disadvantageous to either party, that they can be held up like that. And because of that potential for dispute, people will pay less money for these common tenancy interests than their proportionate share of the whole value.
So in some cases, you might actually get a lower value for that type of an interest as opposed to one inside of a partnership or a limited liability company.
You could, and they're all based on facts and circumstances. And we hear people talking about, well, on average this and the average multiple and that kind of thing. That's very dangerous because those averages may have applied to one case at one particular point in time, but they all need to be based on facts and circumstances that are unique to the specific case.
Okay. Can you distinguish the valuation approach that's used by a business broker compared to a valuation specialist?
Sure. The main issue is that valuation professionals are totally independent. They're interested in the most reasonable value given all the facts that they can apply. A business broker is not independent. They're an advocate for the seller. And that's a good thing when you're the seller.
Yes.
The more they sell it for, the bigger their commission. Appraisers don't operate that. In fact, it's unethical for an appraiser to make his fee based on the amount of the appraisal outcome. So if you're selling a business, you're really more interested in maximizing the cash sale proceeds. So even though my appraisal might be reasonable and might be at the same time less than what someone else could get, in selling it, if there's a party willing to pay you an unreasonably high price, that's the one to whom you should sell it. So it's the broker's job to identify that person who might pay more than it's really worth to get you the maximum out of it.
Right. And part of what we're talking about is when we're talking about like fair value, we're talking about sort of like the general marketplace. But this buyer might view this business differently. So for example, let's say you've got a software company, a big software company, Microsoft. We've got a smaller software company here that happens to be offering something that's very appealing to the marketplace of a Microsoft market. So it's sort of, it fits in well with Microsoft, and so Microsoft might be willing to pay more for that company than the general marketplace might.
Yes, there's both logical and illogical reasons to pay more than what an appraiser would.
Sometimes we got an emotional involvement that could be here too. Yes.
Well, and the logical, there could be combine two companies that both have underutilized warehouses, and you can close one of them, and now you're doing more business with only one warehouse expense. Same thing with certain personnel expense. You need one chief financial officer and controller, and maybe less management personnel, that kind of thing. So when companies are put together, they often can earn more earnings, higher level of earnings, than they would the total of them separately. And that's referred to as synergy. And then like you said, there could be someone who wants to put together a chain of locations in certain geographic areas, and you're the last one in the chain. And they might pay quite a bit more money to complete that process than they ordinarily would.
Right. So when you're talking about actually selling a business or whatever, then we may have other factors that go beyond, again, what you would normally have in a study. Okay, well, we just have a couple of minutes left here, and I'm kind of afraid to ask a big question, so maybe you'd like to share some wisdom related to if somebody is thinking of using a valuation specialist, or when they should seek you out.
I think the most important thing is to check the background and qualifications of the appraiser, to avoid the idea that you can use generalities to value a business interest or a business itself. And what I would do, I would look to people who are accredited and have been properly tested, have an experience requirement, and have a peer review testing requirement to make sure that they've gone through the most rigorous analytical and testing procedure before they're out in the market doing valuation work, and ask for references.
So sometimes you can get what you pay for.
You can.
Okay. Jim, I want to thank you for being my guest today.
Oh, well, thanks for inviting me.
And really appreciate the information that you have shared with our viewers. And folks, I hope that we've given you something to think about and some appreciation for the role that the business valuation specialists play. You know, it's not something that we deal with all of the time, but there are circumstances occasionally that come up where we really do need these people, and so they get involved with litigation and negotiations and all sorts of other things. So I hope I've given you some good information to think about, and we'll see you next time on Financial Insider Weekly.